Right? Now, why we care about it in this class is that financial markets give us this historical information about return that are required for various levels of risk. Right? So they give us a picture of all of this matching over time. And again, our goal here is to generate a model that is based on what we know about risk and return. Right? So remember that one of the fundamental rules of finance is that risk and return trade off. And what that means is that we have to put our money at risk in order to have any expectation of generating a return on that money. Right? So we know there's a reward for bearing risk. We also know that this relationship is a positive one. The more risk we take, the more return we expect or even demand. And the less risk we take, the less return we demand, which is something we've talked about in some detail before. But knowing that risk and return have a trade-off and knowing that there's a positive relationship in that trade-off doesn't do us a lot of good unless we can generate some kind of framework, some kind of model that helps us understand specifically, if I take X amount of risk, I should expect Y amount of return. Right? I want to have some practical way to implement the risk-return trade-off in my decision-making process, right? Because even though I can intuitively understand, for instance, that investing in SpaceX, the rocket company, is more risky than investing in a light bulb company, if I can't have some practical model that allows me to understand how that should differentiate the returns I expect between those two investments, then I'm really still where I was. I'm no better off than not knowing that risk and return have a trade-off, right? So we are working our way towards building that model, and that's really what we're going to do in the next chapter, in chapter 13. But that's our goal, right? Now, the best way to build a model is to look at historical data, right? So the best way to predict the future is to look at the past. And so what we want to do by looking at the history of capital markets is to help guide us on this relationship between risk and return. If we can observe how risk and return have played out in the past, that can help us determine how they might play out in the future, and hopefully that can let us build a model that works. Okay? So what we want to do is start by talking about return. We really want to define return, and so the reason being is that there are lots of different the word return can be applied to lots of different things, and so there are lots of different returns that you'll hear bandied about in the financial literature or in the financial news, and all of those things are referring to slightly different things, right? So just off the top of my head, we can talk about, say, total dollar return, we can talk about holding period return, we can talk about average annual return, we can talk about expected return, we can talk about lots of different types of returns, so we want to be really specific about what we need and where we're going. So we're going to start by talking about the simplest form of return, which is something called total dollar return. This really just is, what is the actual amount of dollars, how much money will you generate from an investment? Okay? And so this is also a really straightforward calculation. Total dollar return is equal to the income that your investment generates, and that could be the dividends from a stock, could be the coupon payments from a bond, could be the rent that you get from a rental property. It could be the money that you generate when you sell your barrels of oil, right? Any of that thing. That's income from the investment. This is the cash flows. Plus the capital gain, which is simply the change in the price, right? So did the price go up or down? That is a capital gain or a capital loss. That is our total dollar return. And so if we look at a specific example of total dollar return, we can look at an example of a bond. Right? So let's say we bought a bond for $950 exactly a year ago today. We received 2 semi-annual coupons of $30 a piece. And today the bond's current price is worth $975. Right? So I can sell it for $975. If I do sell it today, what would my total dollar return be? Right? So again, this is pretty straightforward. The income generated by the bond is the 2 coupons, $30 a piece. So $60 worth of total income. The capital gain is the price change. The price has changed from $975 from $950, so that's a $25 capital gain. The total dollar return is $60 plus $25 or $85. Right? Now, That's total dollar return. It's sort of the simplest way to start thinking about return. But it also, hopefully, obviously, isn't as useful as it could be, because knowing that we've generated $85 in return from our investment doesn't tell me everything I need to know. Because, of course, $85 in return from a $10 investment is a great job. That's 800% return. But $85 in total dollar return from $1 million investment is not a very good job, right? That's 0.01% or something like that. Not a very good return. So what we really want to do is then go one step further and calculate something called the holding period return, which is where we divide the total dollar return by the original price. That gives us 8.95% return. So we invested $950. We generated $85 in total return over the year. That's about a 9% return. And the holding period return is really a sort of useful thing. This is also, it's typically what people mean when they are talking about how much return they got from an investment. So if someone is saying, I generated 10% return on my investment, or I made 300% on this investment since I made it, what they are typically referring to is this holding period return. How much total return have you generated since you made the investment until today? Right? Now that could be different from the annualized average return. So we could take the holding return, and if you've held an investment for, say, 10 years, then we might be interested in not just the holding period return, which is your total return, but how much average annual return you made in every one of those 10 years, right? So there are lots of different ways to chop and slice this information. So we just got to keep that in mind. Now we can look at historical returns with this same idea in mind. So this is a graph of historical returns in the U.S. equities market, bond market, and U.S. Treasury market over the last almost 100 years. Right? Now, when people ask me whether they should invest in the stock market or whether they should start saving for retirement, even though they're still in school and they can only put in $50 a month, or maybe they're 40 and they haven't started a retirement account yet, and they are still waiting to. They're wondering if it's too late, if they've already missed out. This is the graph that I want to show them. This one and the next one, right? Because this is a graph that shows the power of time in investing. So what this says is, if I invest $1 in one of these 5 potential portfolios, how does that dollar grow over the next 100 years? And this is all real data. So what the portfolios are is, this dark blue line is small stocks, right? So this is the smallest half. And so when we say small stocks versus large stocks, what we're talking about is company size. So this is the companies that are smaller than the median in terms of their size, and companies that are larger than the median in terms of their size. Right? So there's all of the companies are represented. Half of them are smaller than the other half. Okay, so we could invest $1 in a portfolio that comprises all the smallest stocks in the market, and or in a portfolio that comprises all the largest stocks in the market. Or this orange line is long-term government bonds, so any U.S. Treasury bonds, and that means greater than 1 year maturity. Or in Treasury bills, those are U.S. government bonds with less than 1 year maturity, or just the inflation rate as a comparison, right? So if we put $1 in the portfolio, how would it change over 100 years? Well, we can look at, starting with inflation, we can look at what happens, right? Inflation is just how much the price of things has gone up. So what we understand from inflation is that it's been about 2.9% per year over the last 100 years. And so what something that would have cost me $1 in 1926 will now cost me $14 in 2016, right? So this doesn't come all the way up. It doesn't include the recent pandemic. So we don't want to confound our information too much. But you can see that inflation has been significant. And, for instance, if I could have bought a gallon of milk for $1 in 1926, now it cost me 14, right? That's the way we think about how inflation affects us. And note that short-term U.S. Treasury bonds don't do very much to outpace inflation. So if I invest my dollar into short-term Treasury bonds, what are called Treasury bills, it only turns into $21, right? So all it does is make sure that the money that I invest isn't totally destroyed by inflation. Right? So I will still have, as my dollar is still worth as much 100 years from now as it is today. So it's keeping pace basically just with inflation. A little bit more than inflation, but not much. Now, long-term government bonds do a little bit better. If I invest $1 in 1926 into a portfolio of long-term government bonds, it turns into $143 today, or 2016, right? So 100 years, give or take. So that's a pretty big gain, right? We have increased our holding period return over that is 143%, right? At 5.5% a year, we're doing pretty well. But it's not. I mean, it's not phenomenal. But hey, for every dollar to turn it into $143, that's nothing to shake a stick at. Right? Now, where the real money is made, and you can see that in the graph, is in our equity portfolio. Right? Now, this is a logarithmic graph, so that we could fit everything in one slide here. But the blue line, the light blue line, this is our large stocks. Right, so this is a portfolio of the largest companies in the stock market in any given year, the largest half. If we invested $1 in that portfolio, it would grow to $7,353 in 100 years, right? Which is enormous. Right? And the crazy part is that's not even the best we can do, because if we invest in the portfolio of the smallest 50% of companies in the stock market at any given year, that dollar grows into $36,929 in the next 100 years, right? So we turn every dollar we could have invested in 1926 would be $37,000 today, which is crazy. If you could put in $1 a month in 1926, and that was it, $1 a month, that was your retirement portfolio, and then for whatever reason you still held it to today, you would be fabulously wealthy. And that's only $1 a month, right? So when someone says, is it too early for me to start investing because I don't have $100,000? I say, it's not about what you put in. It's how long you can put in, right? It's the length of time. If you are, older and you're still wondering if it's too late, well, now you have to be able to put in as much as you can, because you got to make up for some of that lost time. But notice that, if we shrink this time horizon, so for instance, we can shrink this time horizon to only being the last 20 years, you can still observe significant growth. Even in a shorter time horizon, you're just going to have to put more money in. Right? So this is the same set of portfolios, only from 1998 till today, or 1996 till today. We're still investing $1. We can see that the Treasury bills aren't beating inflation over the last 20 years. So if you were only investing in short-term Treasury bills, you're actually losing money relative to inflation. So prices have gone up more than your return. And so what you take out is worth less than what you put in. And we can see that government bonds, long-term government bonds did pretty well, 6.7%, almost comparable to the largest stocks in the stock market, which only returned 7.2%. And small stocks still did pretty well, about 10% a year. So if we invested $1 in a portfolio of the smallest stocks, that would almost grow be about 700% larger, whatever we invested over 20 years. So if you've got 20 years and only 20 years until you want to retire, you just got to put as much money in there, and you could potentially see 400 to 700% return in that time, right? So it's about time, but it's also about if you don't have as much time, you can make up the difference as long as you can start to funnel money into it. Okay? Now, these two graphs also illustrate what we mean by risk and return, right? So this is a graph of our return in a portfolio over time. But we can look at it and understand that it is also, we can see the effect of risk.